It was a stimulus program that helped fuel one of the longest-running bull markets on Wall Street, and it's just ended. Market reaction to the rate hike was positive, with the major indices ending strongly in the green. The move was widely expected.
This is not an unanticipated policy move, and we have been trying to explain what our policy strategy is. So it's not as though I'm expecting to see a marked immediate reaction in financial markets.
Rate hikes tend to be bad for equity markets, but the rise indicates the Fed is more confident about the strength of the U.S. economy than it was 2 months ago, and that bodes well for the markets. Nevertheless, traders said there could be some volatility in the months to come.
I think investors are really just going to wait and see for the first month how our overall market is going to react to that. This is uncharted territory for most of us, and I think taking that into consideration, it's going to take some time for people to figure out exactly what they want to do.
The federal funds rate that was kept at or near zero for 7 years meant that companies could get access to very cheap loans. That was a huge boost to corporate America and a boon to investors.
Since the market hit a bottom in March of 2009, the S&P 500 has rallied more than 170%. Now that the Band-Aid has been ripped off, the stock market will go back to being driven more by fundamentals, the economy, and earnings. Traders say that's a good thing.
It should always be about fundamentals, but unfortunately, or fortunately for investors that were invested in the end of 2008, 2009 to now, they've done very well. But the reality is, you should be investing in stocks based on fundamentals.
On the day the Federal Reserve announced its first rate hike in years, traders were already trying to figure out when the next hike would be, with most betting on June 2016. Karina Huber, CCTV, New York.